Hello and welcome to this video on yield. Yield is a term used in investing that refers to the income return on an investment. Typically expressed as a percentage of the investment's cost or current market value. The yield can be calculated in a variety of ways, depending on the type of investment. One common use of the term yield is in relation to bonds. When you buy a bond, you are essentially lending money to the bond issuer, usually a corporation or government, for a set period of time. In return for this loan, the bond issuer promises to pay you a fixed amount of interest at regular intervals, as well as return your principal investment when the bond matures. The yield on a bond is the annual interest payment divided by the bond's face value, expressed as a percentage. For example, let's say you buy a $1,000 bond that pays 5% interest annually. The yield on this bond would be 5%, because you would receive $50 in interest payments each year. 5% of $1,000, which is 5% of your original investment. Yield can also be used to describe the income generated by other types of investments, such as dividend-paying stocks or real estate. For example, if you own a stock that pays a $1 dividend per share and the stock is currently trading at $50 per share, the yield on your investment would be 2%. $1 dividend divided by $50 share price, expressed as a percentage. It's important to note that yield is not the same as total return, which includes both income such as interest or dividends and capital gains or losses, the change in the investment's value over time. Yield is only one aspect of an investment's return, and investors should consider other factors such as risk and liquidity when evaluating potential investments. For example, let's say a stock pays an annual dividend of $2 per share and is currently trading at $50 per share. The yield on the stock is 4%. $2 $50 0.04, or 4%. Another important concept to understand when it comes to yield is yield curve. The yield curve is a graph that shows the relationship between the yield of different types of bonds and their time to maturity. A normal yield curve slopes upward, with longer-term bonds yielding more than shorter-term bonds. This reflects the fact that investors generally demand higher returns for tying up their money for longer periods of time. In summary, yield is a measure of the income return on an investment, usually expressed as a percentage. It can be calculated in different ways, depending on the type of investment, and should be considered alongside other factors when evaluating potential investments. Thank you for watching today's video on bull market versus bear market. I hope you found it informative and helpful. If you have any questions or comments, please leave them below. Don't forget to like and subscribe to our channel for more videos on economics and finance.